One of history's most shocking catastrophes is about to happen soon. This was the revelation made by an American investor and hedge fund manager, Michael Burry. Nobody knows what Burry sees, just as in 1999 and 2008, but the world is due to awaken shortly. In a tweet, he said while it took years for the theater to become overcrowded with millions of people, the collapse will be swift and unpleasant. Unavoidably, some people will fall behind, and it will be their fault for not catching on. Investors throughout the world will still be in for an unpleasant awakening, even if the warnings have been present for years. Everybody is aware that the government made mistakes. Unsurprisingly, the $5 million in money that the Federal Reserve produced caused prices to surge. As a result, the inflation rate is currently 8.6%. Burry disagrees with the mainstream media and he believes short-term inflation will decline. Although the Fed did not print at a rate of $1.5 trillion per year during the pandemic, the opposite is currently happening. The Federal Reserve intends to reduce the money supply by $1.1 trillion annually. Prices should fall if the Fed stops printing trillions of dollars, since they did so after prices increased. This is taking place when supply chains begin to catch up to demand. Over the past few years, supply chains have been under pressure, but this is beginning to change. The world hasn't been passively waiting for the pandemic to end. We are wired to adjust to a changing environment. There are now new supply chains in place. Businesses are becoming more productive. The building of container ships is increasing. The worry over the availability of goods is in full swing. According to one maritime researcher, 13 more container ships were ordered last week, bringing the total for the year to 239 ships. Even though the year is just halfway through, orders for container ships are already at their 5th highest level ever. Clearly, such a rapid increase is unsustainable. Another analyst emphasized how there is valid cause for concern given the enormity of the prediction. The rise in inventory indicates that the race to produce supplies is beginning. Retail inventory has increased by 24% since last year. The issue with this newly discovered supply is that consumer spending has decreased. The U-Michigan Consumer Sentiment Index reveals that consumer sentiment is at its lowest point in 1.5 decades. Prices will inevitably fall quickly when there is an excess of goods and little consumer demand. Burry is alluding to an impending surplus of supply. When there is an excessive amount of supply in retail establishments and not enough demand, this is known as a supply glut. Retail stores will have to start lowering prices by implementing mass sales as a result of an excess supply. Too many products on the market will significantly reduce business revenues, which will eventually result in job losses or salary reductions for workers. Burry further on this idea by stating the bullwhip effect is what this supply excess at retail represents. This bullwhip effect occurs when a surge in demand prompts suppliers to place excessive supply orders. This is due to the fact that companies frequently order a little extra inventory as a backup. The issue with this is that the supply can be inflated to unsafe levels when a network of businesses all place extra orders. Typically, retailers, wholesalers, and manufacturers make up the supply chain. This demonstration shows how placing too many orders at each stage of the supply chain ultimately results in surplus orders. The bullwhip effect got its name because of how this is comparable to a bullwhip. The bullwhip effect is happening right now, but on extremes. Because of the severe supply shortage, retailers have ordered loads of stock. One of the largest bullwhips in history resulted from this. Additionally, a supply glut is unavoidable when there is a bullwhip. Burry is aware that the impending supply excess will result in deflationary forces and disinflation. When the pace of inflation sharply declines, there is disinflation. Inflation will therefore soon begin to slow down rather than continue to increase as many predict. The bullwhip effect's impending disinflation may prompt the Fed to resume creating money, otherwise known as quantitative easing. The increase in consumer demand from quantitative easing will then lead to a further deficit in supply. The Fed will next begin quantitative tightening, often known as pulling money out of the economy, to stop inflation as a result of the supply shortage. The only issue is that shops will order additional stock once more, which will bring about the bullwhip effect once more. Prices will fall if there is an excess supply, which will prompt the Fed to resume quantitative easing. This would falsely raise consumer demand and cause a lack of supply, which simply prepares the ground for another bullwhip. Such a cycle is worrisome since it keeps the economy stuck in recurring bullwhips. As a result of the fact that we are currently in the bullwhip phase of this cycle, we will soon witness one of the worst crashes in recorded history. The bullwhip effect extends beyond traditional retail chains like Walmart and Target, according to Burry, who explained it this way. Across the economy, different verticals are in different phases at the same time, but fundamental equity investors are rarely looking at more than one vertical at a time. Other industries, from the production of planes to cell phones, may also be included. The bullwhip effect, as was previously established, does not only occur once every 10 years. It's a vicious cycle that only gets worse with time, with prices largely rising in the long run. In the financial markets, bids and asks are usual. The price that buyers are willing to pay is the bid, and the amount that sellers are willing to sell something for is the ask. As a result, a spread develops between the two prices. The asset will then be bought by a market maker, such as Citadel, who will then sell it for the asking price, thereby profiting from the spread. Inflation was so high in June that there were no bids for mortgage-backed securities. This means that there was literally no price that buyers were willing to pay for on-mortgage-backed securities, which are bonds that are secured by home loans. This is a terrifying signal showing that inflation is likely here to stay. This is because even though the Fed is trying to stop inflation, not everyone is on the same page. Burry tweeted an article announcing the inflation relief payments that Californians will receive. This is ridiculous because giving free money is only going to make inflation worse. He ridiculed California's behavior by saying that is not how any of this works. We're clearly in a frightening economic environment, but there must be light at the end of the tunnel. In 2021, speculation reached its peak. As finally, speculation usually results in widespread fear of speculative assets. As of right now, we have not arrived there yet. A brief rally may be seen by some, like Jim Cramer, as a sign of recovery. Burry is aware that market crashes are when short-term rallies occur most frequently. Having the biggest rallies during market breakdowns may seem counterintuitive, but history has proven it to be the case. Every year, we have a massive multi-year crash. There are plenty of 10 to 25% rallies, but you shouldn't mistake those rallies as a sign of long-term market recovery. Short-term rallies mean nothing during bear market. Burry tweeted, "Who knew this year was so much fun because all the doomed rallies?" So given that, how is Burry getting ready for the impending crisis? Contrary to other market crash forecasters, Burry's money is most definitely where his mouth is. People may say whatever they want, but if their money isn't where their mouth is, then they're just lying for attention. Whether this happens or not, we should be prepared all the time. Now, what's your backup plan? Let us know what you think in the comments section below. Thanks for watching this video till the end. I hope you leave us a like and click that subscribe button. This is your 3 Towers Investing channel, giving you the latest in finance, investment, and innovation. See you soon!